Hello and welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today's question comes from Balaji. He's starting retirement with 30 times his yearly expenses saved. He has parked his first 15 years of spending in a fixed income, and now he wants to know how much of the rest should he invest in equity. Dhirendra, no more salary, no more risk, so move everything to FDs. Is that a good way to go about things?
Not really, because it requires great appreciation of the inflation. Think of it like this. Why investing in equity is important. Maybe 30 times his annual income is one aspect of it. But let me give you an example. Assuming somebody's monthly expenses is 25,000 rupees, which means you need 3 lakh rupees per annum every year. And if 3 lakh rupees per annum is your living expense, next year 3 lakh rupees will not be enough. Next year you will need little more, because the cost of living, forget about the complex wholesale price index and consumer price index, but the things that you buy for 3 lakh rupees will cost you more. Something will cost you less, something you may not need, and something else will cost you even so much more, which is unanticipated. So that is the nature of economics. Your expenses go up. And if expenses go up, what is your preparedness? And more so, your mindset changes. Once you retire, once your regular income stops coming in, you tend to get a little more fearful. And understandably, why he is inclined towards fixed income, secure, safe. And the reason why everybody must have equity, one may not assume any equity risk is a different story. But why everybody should assume some equity risk? Because your fixed income strategy is something which was designed to disaster if it is going to be 100%. Because 6-7% is what you earn from fixed income. And if it is more secure, less you earn. And it just doesn't make sense to assume risk with fixed income. Because you're assuming risk with fixed income is taking your return from 7% to 9% and putting your capital to risk. It's just not worthwhile. It is not worth assuming that risk. That the moment you try to take your return from 7% in a good commercial bank or Government of India bonds or senior citizen savings scheme or something like that, and post office MIP, taking it to 11%, your whole capital is at risk, because that company can disappear. It is a rated unsecured. It might be a rated bond, but it will be unsecured, and it is not. And ensuring the return of your principal and capital with your fixed income requirement in retirement is mandatory. It is not a negotiable thing. That is the reason why you are investing in fixed income in the first place. It is not your long-term fixed income allocation for stability. So, to beat inflation, to ensure that your capital's worth is protected, one must have some equity. Now, how much it should be, that is entirely a matter of what is your margin of safety. Assuming that in this case, where you have 90 lakh rupees and you need only 25,000 rupees a month and 3 lakh rupees a year. Maybe a 25%, because maybe a 25%, 30%, or maybe there are other ways of planning your retirement income that put your 3 years requirement in a fixed income so that you are assured of it, because you are looking for reassurance, you are looking for stability, you are not looking for anxiety. But at the same time, for sake of safety, you cannot risk the risk of your principal going down in value while you live. And the biggest risk of this strategy of being entirely into fixed income is that you will outlive your savings. You will outlive your lifetime accumulation. And that is a very that's a very grim possibility to stare at.
Yeah. Coming to this particular case, Balaji has 15 years of expenses logged in safe assets. So he wants to know how much equity should he invest, how much of equity for the rest.
I think for the kind of person Balaji is, he's conservative, understandably so, and very thoughtful too. So I think if he has 15 years of fixed income already locked in, which means he doesn't have to bother about it. For him, I would suggest that entirely. If he's tilting towards being little venturesome, then maybe a balanced advantage fund, or that's a low maintenance tax deferred. And why it should be like that? Because he's deferring all the taxes. He's unlikely to pay any taxes for the next 15 years, because all his income requirement is being fed by the income that he has been able to log. Remaining money can well be 65 50% or 60% into equity, but it will be done through a vehicle which will automatically reconfigure itself. Sometimes it will be 35% equity, sometimes it could be 65% equity, and it will be opportunistically so, without him to bother about what it should be. So choose one or two balanced advantage fund, spread the investments over a period of time, and next 15 years, I think that has the greatest potential of beating inflation, having a larger pool, and he will completely de-risk himself from the inflation risk over this period of time.
Now, talking about a scenario, what if market crashes 6 months after I retire? What happens then?
Oh, for that he is already taken care of, because if you have 15 years worth of income locked into fixed income, then in fact you should feel happy, assuming that you are going to put remaining 50% into that vehicle, which is a long-term gains vehicle. Maybe spread it over the next 18 months so that you are able to catch some low. Market goes down and you are able to buy even larger chunks of those units. It doesn't matter. Markets will be like this only. It can fall soon after you invest. It can fall 2 years after you invest. It can fall 4 years after you invest. It can well fall after 12 years when you are taking. But then after 12 years, the pleasure is somewhat different. When your money, in investor psychology, investors' behavior, their reaction to a big fall, assuming my 100 rupee becomes 500 rupees, and then it comes down to 250 rupee, I don't have as much regret, though it has gone down in value and in a very devastating way, coming down by 50%. But if I invest my 100 rupee and it becomes 90 rupee after 3 years, I'm extremely disappointed, because now I am comparing it with my opportunity losses had it been in fixed income. And normally these things happen when such a thing happens, fixed income rate is even higher. Your sense of opportunity loss of being had you been a risk averse investor is even more.
You advised Balaji a balanced advantage fund. Is there any other plan that he can follow?
Yeah, in fact, balanced advantage fund is the most conservative plan. Half his money is in fixed income anyway. And the remaining money, 2/3, which means of the 50 rupees that is left, of which 33% is only in fixed income. Remaining is in equity. That too at the very opportune time. That is the maximum allocation he will have. So of his overall 100%, it will be 33% into equity. So that is a fairly conservative plan. I think for somebody like Balaji, he will also be fine with a aggressive hybrid fund, which is 75% into equity all the time. And also because this is going to be 15 years, because he's unlikely to touch that money or need that money for next 15 years, unless there is some emergency or some special need. So it is either aggressive hybrid, which is substantially equity, or entirely equity. A multi-cap, flexi-cap fund is also fine, spread over the next 2-3 years. That I would say is a conservative plan, because on an overall portfolio basis, this is conservative. And the real conservative plan is the balanced advantage.
Now, Balaji still has some margin of safety. What if someone doesn't? Yes. What if someone doesn't?
Assuming somebody needs 3 lakh rupees per annum, 25,000 rupees a month, and he has 50 lakh rupees. That person does not have that margin of error, or does not have the risk tolerance of assume a higher risk. He should do something little differently. One is that he should create his not 15 years, but at least 3 years worth of need, which means of his 50 lakh rupees, 9 lakh rupees should go into a fixed income vehicle from which he will derive 25,000 rupees over the next 3 years. Cut his budget within that 3 lakh rupees a year, 25,000 rupees a month. Remaining 41 lakh rupees can be invested into little conservative vehicle. 75% fixed income, 25% equity. that is the only way he will be able to protect, and that money should get invested as quickly, so that in the next 3 years, while he's consuming his fixed income allocation from via SWP or a post office MIP or a mix of these, then that money can actually grow to an extent that when he starts withdrawing from there, he has some buffer, he has created some margin, and that money can well be, I think, in this case, because your risk tolerance will be decided by your scale of withdrawal, and being aggressive or conservative is a margin of safety that you want to build into your plan.
Right. Now, there's one more question that Balaji wants answered. He says, can he push equity to 60 or 70% for a higher return?
Absolutely. That is what I was actually, that is what my aggressive plan was. Right. But he should do it in a low maintenance way. He should do it through a vehicle where he will not have to intervene. It should, and he does not have to buy or sell something so that he has to rebalance it. And this is where choosing a good aggressive hybrid fund, which is 75% equity, 25% fixed income. That is what I was saying, that is the aggressive plan.
Right. All right. So be methodical, plan carefully, and be optimistic about the future. You can actually leave a larger estate. That's it for this episode. We'll see you next week.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.